Welcome to the Capital Spreads Weekly Update. Today is Monday the 4th of February 2013. We saw, of course, a very, very strong January, the third best January on record for the FTSE, and the strength did sort of continue into the first day of February. We saw last Friday the Dow, of course, get over the 14,000 level, something not seen since 2007. So certainly a great deal of bullishness still surrounding the US indices. But just today we're seeing a little bit of profit taking as we commence this week, a little bit of uncertainty over just how much further this rally can continue to go when you've got various things coming up in the next few weeks. You've got the Italian election at the end of this month, and then of course come March you've got further negotiations on the US fiscal cliff in terms of their spending cuts. So it just seems a little bit of apprehension from the buyers, reluctant to push further the equity markets that have of course had such a good start to the year. So FTSE's around 63.10, Dow at 13,970. Euro as well, also seeing a little bit of weakness. It's 135.65. Cable at 157.20. Gold at 16.65. And Brent at 116 on the figure. So as mentioned, today we've seen that bit of profit taking. And we've also seen a speech from George Osborne, the Chancellor, on banking reform. That seems to have just caused a little bit of selling to banking stocks, but nothing too drastic. And really we go into tomorrow when the sort of economic data for this week kind of really gets underway. And there's a lot of services PMI numbers from both the EU and the UK. Importantly for the UK, of course, services contributing a substantial amount to the overall GDP in the economy. Last time we saw the survey dip below 50, which of course suggests contraction for the services sector. And on the whole, people are expecting it to bounce a little bit. But whether it will get back above 50, of course, is really to be seen. So we'll be focusing closely on that. We also get EU retail sales tomorrow, and then in the afternoon we get ISM non-manufacturing from the US. Of course, the US saw recently consumer confidence dip quite significantly. So again, their non-manufacturing data might struggle a little bit. On Wednesday, very quiet day indeed. We've got German industrial orders. Then we move into Thursday. And Thursday, very much all about the central banks. You've got the Bank of England, you've got the ECB as well, announcing interest rates. And that will probably be the main focus point for this week. In terms of the Bank of England, the question will be whether they're going to increase quantitative easing, because of course we saw last quarter the GDP figure dip back into contraction. However, the governor has been very vocal in saying that he thinks that the supply side is more to blame for the ailing economy, and that really quantitative easing may not be the answer for addressing that. And of course the funding for lending scheme has to a certain degree it has eased credit conditions. So the consensus is that there won't be any increased QE from the Bank of England. Then we'll focus on the European Central Bank. Of course, questions there about the LTROs that are being repaid at the moment. That has seen to a certain amount a normalizing of the yield curve, and it may open the way now for a possible rate cut. It's not expected this Thursday, but it is probably getting closer to that as things normalise. And also the euro has seen quite a bit of strength recently, which is not going to do very much good for those peripheral nations that really do need a much weaker euro. So lots of focus on central banks on Thursday, and of course Thursday does see initial jobless claims from the US as well, that weekly figure. And then Friday again a quiet day, and it's a quiet end to the week. Really, it's going to be trade balance data that we'll be focusing on, and that's from China, Germany and the US. So Quite a quiet week, but lots to focus on in terms of central bank decision making. That's it. As ever, do give us feedback, media@capitalspreads.com.